Is RSI better than the stochastic oscillator when it comes to spotting price reversals? Many traders ask this, and today, we're breaking it down. In this video, we'll explore how each indicator works, what makes them unique, and when to trust one over the other. I'll walk you through real chart examples to show how they perform in different market conditions. By the end, you'll know which one fits your style, or how using both can improve your strategy. Let's dive in. This might change the way you see momentum forever. So stay with me until the last chart. That's where theory meets reality, and where your real edge begins. Quick overview of indicators. RSI. The Relative Strength Index, or RSI, measures the speed and change of price movements. It ranges from 0 to 100, and is typically used to identify overbought and oversold conditions. Stochastic. The Stochastic Oscillator compares the closing price of a security to its price range over a specific period. It consists of two lines, %K and %D, and ranges from 0 to 100. It's designed to indicate momentum shifts and potential turning points, especially in sideways markets. RSI versus stochastic, key differences. Now let's summarize the key differences between RSI and the stochastic oscillator in a quick table. Then, we'll go through 3 real market examples in different conditions, trending, ranging, and bearish, to help you understand exactly which indicator works best in each situation. Basis. RSI is based on the speed and magnitude of recent price moves. The stochastic oscillator, on the other hand, compares the closing price to its recent price range. Signal type. RSI is a single-line oscillator that moves between 0 and 100. Stochastic uses two lines, %K and %D, and creates crossover signals for entries and exits. Sensitivity. RSI is moderately sensitive and tends to filter out some of the noise. Stochastic is more sensitive and can give earlier signals, but that also means more false alerts in choppy markets. Best use. RSI is great for confirming momentum shifts and spotting trend exhaustion. Stochastic excels at detecting short-term reversals, especially in sideways markets. Common setting. Both indicators commonly use a 14-period setting. Stochastic often adds a 3-period smoothing to reduce noise on the %D line. So, just like with MACD, it's not always about choosing one over the other. The key is understanding what each one tells you, and how to use them based on your trading style. Chart comparison examples. Let's take a look at how RSI and stochastic behave on real charts, and see how they perform in live market conditions. First example, RSI reacts faster, stochastic gives noisy signals. Here, RSI quickly bounces off the 30 level after a sharp dip, signaling a potential buy early on. It's sharp and responsive to momentum changes. But the stochastic oscillator is jumping around, crossing above and below 20 several times, creating confusing and false buy-sell signals. If you want a cleaner, faster signal in trending markets, RSI is the better choice. Stochastic might be useful in slow or sideways markets, but can be too sensitive in strong moves. Second example, stochastic outperforms RSI in range-bound market. In this chart, the market is clearly moving sideways. Price is trapped in a narrow range with no strong trend. RSI stays flat, hovering between 40 and 60, never reaching overbought or oversold zones. It offers no clear trading signals, just vague momentum, with no direction. But the stochastic oscillator performs much better here. It cycles smoothly from above 80, overbought, to below 20, oversold, giving multiple precise entry and exit signals. For range traders, this is gold. While RSI is silent and indecisive, stochastic catches every small swing, showing its true strength in non-trending conditions. Third example, RSI filters out false stochastic signal in downtrend. In this chart, the market is clearly trending down, lower highs, lower lows, and strong bearish momentum. The stochastic oscillator crosses above 20, which usually looks like a classic buy signal. But RSI stays below 40 the entire time, showing there's no real strength behind the move. No confirmation. No entry. Soon after, price drops again, continuing the downtrend. That early buy signal from Stocastic was a trap, and RSI helped us avoid it. This is where RSI shines, filtering out false signals during strong trends, keeping you on the right side of the market. Let Stocastic show you the setup, and RSI confirm the quality. When used together, they reduce false signals and help time entries more precisely. You'll find the link to my RSI plus Stocastic combo videos in the description. Go take a look. If this helped clarify things, hit that like button, subscribe, and tell me in the comments which indicator has worked better for you in your trades. Remember, great traders don't pick tools blindly, they test, observe, and combine what works. Let's grow smarter, one indicator at a time.